Welcome back from the short break. For those who just tuned in, you are listening to Economic Chat. Let's Talk Business with Mr. Daniel Steinman and myself, Elsabe Tiunyani, and we are talking about the first quarter, or rather the first calendar quarter for 2023. But Mr. Daniel Steinman did, of course, elaborate or give us definitions of the different quarters, the fiscal quarter, the financial quarter versus the calendar quarter, but also giving us a breakdown on comparing this year's calendar quarter 2023 to the previous years, and that is also how COVID did just totally shut down the world economically. But we have survived it. We have, we've made it so far, Mr. Daniel Steinman, I should say.
We think so, Elsabe.
But I think we've made, or not, we certainly didn't make it, but we have come this far as surviving the storm.
The thing that I said about the psychological impact of the first quarter's performance is very, very, very important.
Yeah.
Because if you look at the type of headwinds that we can expect this year, the first one is inflation. The March inflation figures has just come out at 7.3%. So we were actually expecting it to have crested from the 7.2% in February. I would have been more comfortable if March inflation was 6.9.
Okay.
Not a big difference, but that you can see movement. It's gone over the top of the hill. Didn't happen. Slightly higher in March. So inflation is the one thing that we need to keep both eyes on, because the interest rate movements, there where it hurts your pocket and where it hurts my pocket, that by necessity has to follow the inflation curve. Otherwise, we will run into liquidity problems. Now, if you remind me somewhere in the future, I would talk a whole day about liquidity and why it's so important. But the only thing that you need to know is that for this discussion is that inflation tends to increase liquidity, and you need to reduce that excess liquidity, and you do it by raising the interest rate. So what it means is that you make the cost of money more expensive. But that is also a whole discussion on
for another day.
For another day, because it becomes very technical.
Yeah.
And then you sort of drown the issue in facts and figures, and it starts sounding like a university lesson, and the people lose interest, and they say, man, I'm only interested in how much more do I pay on my loan or my overdraft or
rates,
whatever. So there's almost nothing that you can do if inflation stays where it is.
Yeah.
And if it doesn't subside, the expectation is still that inflation is going to come down. But the good news that we get from the first quarter performance, the GDP growth, is sort of neutralized by the bad news that we get from inflation that stays stubbornly high. Because remember, we're not used to inflation above 7%. We've become, at least you guys are not. I grew up in an era where inflation was regularly 20, 21, 22, 23%, So it is not nearly catastrophic. But it is high in international standards.
Yeah.
So we need to get our inflation to below 6%, and there's a very good reason for that. That is that the target set by the South African Reserve Bank for inflation, they call it an inflation band, is between 3% and 6%. 6% tends to be too high and 3% tend to be too low, but inflation is never static. So it fluctuates all the time, and this is the important thing, is that we need to get that inflation down now, and the good reason to do that is by raising the interest rates. or I shouldn't say good, the effective, the proven way to do it is by raising the interest rates. But the moment you do that, you also slow down the economy. Now, can you see we are now between a rock and a hard place, because we want to boost the economy, we want to accelerate growth after 2020 and 2021. We need to accelerate growth.
Yeah.
But this is now the one target the one goal that we have. And now we see inflation has really gone far above what we expected. The sad part is it is not our inflation.
Yeah.
It is imported inflation. We did not cause that inflation. We suffer from it. So we are on the receiving end of the inflation, not on the generating side. And as we speak, the Bank of Namibia has increased the interest rate again now by 25 basis points, or 0.25 percentage points. Same thing, again, topic for another day. So the interest rate, the repo rate, is now 7.25% as of today.
Okay.
But it is still very high. The good thing is that they increased only by 0.25%, 0.25 percentage points, and not by 0.5% like the previous time.
Yeah.
It was 50 basis points or 0.5%. So it also shows you that they've come to the conclusion that we now need to slow down with this increasing interest rate. And it is possible that this one that we saw now at the beginning of April may be the last interest rate increase for this year. I'm not making that, it's not a prediction, it's a hope.
Because I really got excited right now for that news. But shall we end it there with that hope?
Yes. And the good news that we had a good first quarter.
Yeah.
That we can continue, that can carry on for the rest of the year.
Okay. All right, Mr. Daniel Steinman, thank you so much for coming through yet again. And also thank you so much to the listeners for always tuning in to listen to this important conversation.
Also, and remember the email?
Yeah, I know. I'm getting there, Mr. Steinman. And in case you want to probably suggest that we need to talk about a certain topic that you do not understand, or you want clarity on it, or seem to be that, society is affected by it, you can email that to elsabe@energy100fm.com, and then I will respond. So make sure you send your email. You can, of course, also call me on the office number 061256378. I almost gave the studio number, but you can call me on that number and I will respond. Mr. Daniel Steinman, once again, thank you so much.